Welcome back to the Financial Freedom Show. My name is Rob Berger. In this video, we're going to continue our series on the 4% rule. Recall that the 4% rule was developed by a certified financial planner by the name of William Bengen in 1994. And it's a pretty simple rule dealing with how much we can take out and spend each year during retirement. How much can we take out of our retirement savings? And what he found based on historical data was that in the first year we could spend 4% of our portfolio, and then every year thereafter we could increase whatever we took out the prior year by the rate of inflation. And if we did that, we were likely, no guarantees, but based on historical data, likely not to run out of money during retirement. Now, he assumed sort of a traditional 30-year retirement. Say you retire at 65 with a life expectancy to 95, right? So in today's video, what we're going to look at is how your asset allocation, that is what you're actually investing in, affects the 4% rule. Can we just invest in whatever we want and the 4% rule will work? Well, it turns out no. I wish that were the case, but unfortunately no. How we invest our money matters a lot. So we're going to do four things in today's video. First, we're going to look at Mr. Bengen's original 1994 paper. He draws some very important conclusions that we need to understand. That's the first thing we're going to do. Then we're going to look at a subsequent paper he published. It was in 1997, where he looked at a nuance in terms of asset allocation, actually introducing small cap stocks into his analysis. We're going to look at what he found there. Then we're going to look at something known as the Guyton-Klinger rule. Those are just the names of the gentlemen that published the paper, Guyton and Klinger. We're not going to do a deep dive on that because it gets into a lot of other topics that we'll cover later in the series. But we are going to look at briefly the Guyton-Klinger rule and specifically their asset allocation. And then we're going to finish with looking at target date retirement funds. And based on everything we've learned in the video, what can we conclude about whether target date retirement funds are a good place to keep your money, not when you're, say, in your 30s or 40s and you're building up a retirement portfolio, but when you're actually ready to retire. So we're looking at Bengen's original paper. Again, this was from 1994. And the first question is, what was sort of his primary asset allocation that he assumed in his analysis? And actually, if we just scroll down, and I'll leave links to all of this in the description for the video, but you can see here I've highlighted it. He assumed sort of two things. The first was he only used two asset classes. So the first one was basically U.S. large cap stocks. You can think of an S&P 500 index type of fund. That was the first thing. And that was what he assumed for stocks. He didn't include any international stocks, REITs, emerging markets, small cap. It was just an S&P 500 index fund. And then for bonds, he assumed intermediate term treasury notes. So that's U.S. government issued bonds with intermediate term durations or maturities. So not long-term bonds, not short-term bonds, intermediate term. And that was it. Those were the only two asset classes he used in his initial analysis. And for what we've kind of come to know as the 4% rule, he assumed a 50-50 allocation. So 50% in the stocks, 50% in bonds. And in fact, if we look at his chart, which we've looked at in previous videos, we'll look at this one here, figure 1B. This assumes a 4% initial withdrawal rate. And as you can see, he assumed 50% in stocks. And this is sort of the chart. This is the 4% rule, right? It's creation right here. Now, you can see that for most of the retirement years, beginning in 1926, the portfolio lasted 50 years. That's what the black bars mean in the bar chart. Again, he stopped analyzing the portfolios after 50 years. You can see for some of them, they don't make it to 50 years. For example, 1937, 39, 40, and then into the late 60s, early 70s, they fall short. But they do all pass his 30-year test. They all last 30 years. Now, what a lot of people don't know is that in this paper, he looked at other asset allocation plans. Now, again, he stuck with just those two asset classes, S&P 500 index, intermediate term treasury notes, but he looked at different allocations between those two asset classes. And so he looked at everything from 0% stocks, putting it all into bonds, all the way up to putting it all into stocks and not putting anything into bonds. And He did it in 25% increments. And here's what he found. He found that the best place to be for what he calls portfolio longevity, keeping your portfolio lasting at least 30 years, is that your stock allocation has to be somewhere between 50% at the low end and 75% at the high end. And I think for a lot of folks, particularly in retirement, that can be surprising. That can seem awfully risky. I mean, I know very few folks in retirement that allocate 75% of their portfolio to stocks. Maybe 50-50, but I know a lot of folks who actually have less than 50% in stocks in retirement. And what he found was doing that can actually hurt your portfolio longevity, which is just a fancy way of saying you might have to start with an initial withdrawal rate that's actually lower than 4% if you want to have a portfolio that doesn't include at least 50% in stocks. And we can look at the chart that he came up with. The best one, he's got a lot, of course, in this article, but this is one I think that probably most clearly shows this distinction. You can see in the bottom of this chart, he has 0% stocks all the way up to 100% stocks. And those correlate to the various bars in the bar chart that he's grouped in a series of 5. And below the bar charts, you'll see 1%, 2%, all the way up to 8%. That represents the various initial withdrawal rates. Now, of course, we know today that the outcome of this paper was 4%, but let's actually start at the 1% withdrawal rate. And you can see that if you're going to only withdraw 1% in the first year of retirement, I don't know too many people that start that way. Pretty hard to afford retirement, taking out just 1% of your portfolio. But if that was your situation, what he found was it doesn't matter how you invest. You could actually put all of your money in bonds or all of your money in stocks. Because your initial withdrawal rate is so low, all of those different asset allocation plans allow your portfolio to last 50 years. Again, probably not realistic for most folks because the initial withdrawal rate is so low, but that's the data as he found it. But look at this. If we go up just to 2%, which still is a really low initial withdrawal rate, look at that first bar. It falls from 50 all the way down to, we'll call it about 35. And that's the bar that represents 100% bonds, 0% stocks. Even at a 2% initial withdrawal rate, we start to see how a portfolio that's tilted entirely to bonds can really start to hurt the longevity of the portfolio. Why? Because long-term bonds just don't return nearly as much as stocks. Now, if we go to the 3% initial withdrawal rate, we're sort of getting warmer when it comes to, I guess, reality, but you can still see the first two bars, the first one representing no stocks, the second one representing just 25% stocks, they start to take a haircut. The 100% bond portfolio really falls short. It's around 20 years of longevity. The 25% stock is now fallen, it looks like a little bit below 40 years. The other three are still at 50 years. Where things really, I think, get interesting is when we focus on the 4% withdrawal rate and the 5% withdrawal rate. And what we see are two allocations that are sort of competing with one another. They're the 50% stock allocation and the 75% stock allocation. And this chart shows you kind of why Bingen ultimately concluded that that's the range you need to be in, particularly if you want to start your initial withdrawal rate at around 4%. If you go lower than that, as we've seen, you can start to run into trouble because bonds don't generate enough returns long term. If you go higher than that, 100% stocks, for example, you can also run into trouble, particularly if you happen to retire in years that sort of are similar to, say, the 1929 stock market crash, which lost about 90% of its value over the first few years of the Great Depression, or sort of the early 70s where you had bad stock markets combined with heavy inflation. You can start to run into some serious trouble. Now, all of this raises an important question. Okay, 50 to 75% in stocks is the sweet spot, but there's a big difference between 50% in stocks and 75%. We want to say to Mr. Bingen, can you give us a little guidance here? I mean, should we sort of err on the side of 50% in a conservative portfolio? Or maybe we should take on some risk and go to 75%. Well, here's what he said. He said, look, in terms of longevity, that is your portfolio lasting at least 30 years, frankly, doesn't much matter. When he looked at all of the different starting retirement years beginning in 1926 all the way up to 1976, he only found one year that favored an allocation at 50%, and that was 1966, which is basically the worst year you could possibly choose to retire in over the last century. Other than that, the longevity in terms of at least lasting 30 years, all of the years were pretty much the same, and a 50% stock portfolio did just as well as a 75% stock portfolio. Where he found that there was a difference, though, was in wealth creation. It's one thing for your portfolio to last 30 years, but that doesn't answer the question, how much money do you actually have left at the end of the 30-year period? And that's particularly important for folks who want to leave money to their children or to charities or to others. How much they have left over does matter to a lot of folks. Yes, portfolio longevity is critical, but it's not the only thing that matters for a lot of folks. And what he found here was quite interesting. Let me show you a chart. We'll begin with this chart. This chart shows us how much money you'd have left over, not after 30 years, but after 20 years. It assumes a 4% initial withdrawal rate, and as you can see, this only assumes 35% in stocks. And the way you read this chart is, for every dollar you started with, and you can think of this in millions, what do you have left? And you can see for some years, like 1975 and 76, you almost had twice as much money as you started with. But of course, in all years, you had still a fair amount of money left over. But how does this compare with other stock allocations? Well, let's scroll down. We can see here, and we can compare them both on the screen at the same time. The chart at the bottom shows 50% in stocks, and you can see that pretty much, with maybe a couple of exceptions, when we allocate 50% of our portfolio to stocks, we have more money left after 20 years, in some cases significantly. If we look at 1975, if we started with $1 million, after 20 years, we'd be close to $3 million in our portfolio. We'll call it 2.7 or $2.75 million. But the point is, with an allocation of 50% in stocks, we end up with a lot more money after 20 years than 35% stocks. Now, if we keep scrolling, we'll see the 75% chart, the 65% chart, and then 75%. And you can see the numbers. Try that again. There we go. The numbers continue to go up. I mean, again, there are a few exceptions. In fact, on the 75% stock, if we look at the year 1929, as we might expect since that was the great market crash, our portfolio didn't do so well at 75% because we took, obviously, a big loss, even in deflationary times, as we saw in the early parts of the Great Depression. But other than that, portfolios were sometimes 3, almost 4 times what they started at, with a 75% stock allocation. At a 65% stock allocation, not quite as rich, but still quite good. So portfolio longevity, as important as it is, isn't the only factor. It's also how much wealth you'll have. In this data, we were looking at how much wealth after 20 years. So what does it all mean? Well, here was Bengen's ultimate conclusion. He said, sorting this all out, I think it's appropriate to advise the client to accept a stock allocation as close to 75% as possible, and in no cases less than 50%. Stock allocations lower than 50% are counterproductive in that they lower the amount of accumulated wealth as well as lowering the minimum portfolio longevity. Somewhere between 50% and 75% stocks will be a client's comfort zone. So there you go. That was Bengen's ultimate conclusion. We want to be between 50 and 75%. We'd like to be as close to 75% as you and I are comfortable with. Now, as helpful as that information is, it still raises one question, and that is, should we add other asset classes? He just looked at S&P 500 index and intermediate term treasuries. What else could we consider? And in a paper 3 years later, 1997, he actually began to answer this question. He specifically looked at adding small cap U.S. stocks to the portfolio, and his question was, can we increase the initial withdrawal rate by adding small cap stocks? And if so, what percentage of small cap stocks should we add, and how would that affect the initial withdrawal rate? So to answer that question, let's look at his 1997 paper. And again, I'll leave a link to this in the description. And I've fast forwarded, so to speak, in this paper down to what are really the key charts. he actually answered a number of different questions about the 4% rule in this paper, not just asset allocation. And so this chart tells us a number of things, but we need to first understand what he's done here. In this case, he assumed an initial stock allocation, this includes large cap and small cap, of 63%. Of that 63%, he assumed 30% would go to small caps, again, the rest to an S&P 500 index. But he also assumed that in retirement, you would decrease your total allocation of stocks by 1%. Now, for us, unfortunately, that means we're not exactly comparing apples to apples with his 1994 paper. That 1% phase down of stocks does change things a little. It was actually something he went into in more detail in this paper, which you can check out if you'd like, and we'll cover that in a future video. But let's today just focus on the small cap. Now, what you can see in this chart is the initial withdrawal rate, assuming, again, that 30% of your stock allocation went to small caps. In that first bar, you'll see 100%, and then you'll see a white bar of 30. And then below that, you'll see 4.26%. So what does that mean? Well, it means that if you start with an initial withdrawal rate of 4.26%, you will be successful. Again, success defined as a portfolio lasting at least 30 years, 100% of the time based on Bengen's analysis. Now, what does the 30 mean? That was the shortest time period the portfolio lasted when he looked at all of these retirements, again, going back to 1926. Now, if you boost your initial withdrawal rate to 4.5%, 4.5%, you're still successful. That is, your portfolio will last at least 30 years most of the time. But as you can see, it's not 100% of the time, it's 96% of the time. What was sort of the worst case scenario? A portfolio that lasted 25 years. And you can see as you go to the right of this bar graph, he slowly increases the initial withdrawal rate. And of course, the numbers change as he does. Now, by way of comparison, this bar chart shows his initial analysis based on his 1994 paper, but again, assuming 63% initial stock allocation and a 1% phase down of stocks. And you can see the 4% rule is actually 4.09%, so a little bit higher than 4%. But here's the real takeaway. By adding small cap stocks, we can increase that initial withdrawal rate, not by a lot, but by a little, 4.26%. That was his conclusion in this paper. Now, what's my takeaway on this? Well, first of all, I certainly don't think that adding small cap stocks to a portfolio will hurt. Long term, they tend to be more volatile, but have a higher expected return. And certainly in my portfolio, I currently allocate 10% to small cap stocks. I personally think allocating 30% is too rich for my blood, but of course, that's what he found in his paper, and I want to present to you that information. Ultimately, you'll have to decide for yourself what is best for you and your portfolio. But the real key takeaway is I think we can do a little bit better with the initial withdrawal rate by changing some of the asset classes we use in our portfolio. Will this repeat itself going forward? Well, I guess only time will tell. But this data is based on looking at decades of data going all the way back again to 1926. So I think it's probably the best data we have. Now, again, even with this paper, he was still only considering 3 asset classes, right? Large cap stocks, small cap stocks, intermediate term treasuries. Can't we get even more creative, right? What about international stocks, for example, which are completely missing from his analysis? And that question takes us to the Guyton-Klinger rule. Now, you're looking at the paper, again, published by Jonathan Guyton and William Klinger in 2006. Before we jump into this paper, there's one thing that you need to understand about this article, and that is it deals with what I'll call dynamic spending rules. What do I mean by that? Recall that with the 4% rule, each year we adjusted the amount we had taken out by simply adding inflation to the previous year's amount. So there's nothing really dynamic about that. We sort of work in lockstep. If we took out, let's say, $40,000 from a $1 million portfolio in year 1, Thereafter, we simply adjust that 40,000 by inflation. There's no discretion. We don't look at how the stock market is doing. We don't look at our portfolio. We simply adjust the prior amount by the rate of inflation and then just keep moving. Well, Guyton-Klinger said, that's not actually the only way we can do it. Can't we put up some guidelines? For example, we might say that if the stock market is down in a given year, maybe we won't adjust our spending the following year, or maybe we'll adjust it by a little less than we normally would, just following Bengen's 4% rule. Or perhaps we'll make some adjustments if inflation is really high. For example, we'll never adjust our portfolio by, let's say, more than 5%. Now, in today's low inflation world, 5% doesn't seem like much of a guardrail, as sometimes it's referred to. But I can remember when inflation was double digits. So in that kind of environment, should we ever encounter it again, limiting the adjustments to 5% could be quite significant. But the point is, the Guyton-Klinger rule uses these sort of dynamic spending rules in their analysis. We're not going to cover that in this video. I will cover it in a future video, but I needed to point that out before we look at the asset allocation that they used in their paper. So having said that, let's drop down to the asset allocation, and you can see that it's much more, involved than Bengen's allocation. You can see they use a number of asset classes. They use cash, fixed income, which is just bonds, U.S. large cap value, U.S. large cap growth, U.S. small cap value, U.S. small cap growth, international equities, and real estate. And then within that, they look at different allocations to the equities. And you can see from the chart, they look at 50% equities, 65% equities, and 80% equities. I personally think for a lot of investors, their approach in terms of what asset classes they use is probably a little more realistic. It certainly is for me. I don't follow this asset allocation plan. I use other asset classes, but mine is probably more closely aligned with what you see here than simply using an S&P 500 index and intermediate term bonds, or perhaps throwing in some small cap stocks. So the point I want to make is there are a lot of different ways to allocate your money, even within the stock allocation of your portfolio. I still believe that the single most important decision we have to make as folks in retirement is how much we allocate to stocks and how much we allocate to bonds. However, within the stock allocation, which sub-asset classes we use, it's an extremely important question. Now, again, it's not as important as stocks versus bonds in my view, but it's nevertheless important. We'll dig into that in a little more detail when we get to the dynamic spending rules, but I wanted to show you the results of their analysis. And here they are. You can see initial withdrawal rates that range from a low of about 3.5%, but some of them, as you can see, go as high as 4.5%. So that's a pretty significant difference over 4%. But again, there are a lot of assumptions baked into this analysis that you would need to carefully understand. We will cover it in a future video, but I'll leave a link to this paper in the description below if you'd like to dive into this topic between now and the next video. Now, all of that brings us to target date retirement funds. Are they a good way to invest your money once you actually reach retirement? And in my mind, to answer that question, I need to understand if these target date retirement funds allocate my money in a way that's consistent with what Bengen found and what others have found since the 1994 original paper. Now, to understand this, we have to understand the difference between what are called to, that's TO, and through target date retirement funds. Recall that with the target date retirement fund, the asset allocation of the fund changes as we get closer and closer to the target date. So for example, if I invested in a target date 2030 fund, the allocation today will look different 5 years from now. As I get closer and closer to 2030, the fund will change the allocation, moving more of the investments towards bonds and safer investments and away from stocks. So what does to and through mean? Well, with some target date retirement funds, once you hit that target date, let's say 2030, the changes in asset allocation stop. That would be a to target date retirement fund, meaning I could keep my money in there, whatever that allocation is, it stays that way even in 2035 and 2040 and 2050. Through target date retirement funds continue to change the allocation for some period of time through that date. So if I had the 2030 fund, the allocation would continue to become even more conservative in 2031 and 2032, 35 and 40. How long after that target date the allocation continues to change varies from one fund family to another. But I will tell you that in my analysis, most target date retirement funds fall in the through category. Some continue to change the allocation for 5 years after that target date, or 7 years, or 10 years, or longer. But the vast majority of target date retirement funds that I've analyzed are through funds. So it's not enough to simply look at the target date allocation based on when you retire. We also have to see what's going to happen in years beyond that. Now, if that doesn't make a whole lot of sense, let's look at an example. On the screen is Vanguard's target date retirement funds, and you can see they have a number of different target dates based on your age. And so if you have years to retirement are 0, they recommend the target date 2020 fund. So let's start with that, and let's look at its allocation. We can see here it's not quite 50% stocks, 48.66, but I suppose from a Bengen analysis, it's close. I'd certainly prefer it to be at 50% stocks, but that difference is probably not going to make a huge difference. But what happens is we move through our 2020 date, and we can see that in funds like in retirement. This is someone born from 1949 to 52, and if we look at this fund, we can see that, unfortunately, they start to get even more conservative. Now we're down to 35% stocks. Based on Bengen's analysis, I certainly wouldn't keep my money in this fund in retirement. It's just too heavily weighted in bonds. And in fact, if we go all the way over to someone born before 1949, and we look at this portfolio, we can see that it's down to 30% stocks. So this is a very important thing to understand. I think target date retirement funds can be a reasonable option, particularly if you're just getting started and you want some sort of one fund to put your money in a 401k that you don't have to think about. But I have yet to find a target date retirement fund that I think is a good option once you are near or in retirement. Whatever you decide, the key is to understand two things. One is your asset allocation matters when it comes to the 4% rule, particularly how much you put in stocks and how much you put in bonds. You can put too little in stocks, you can put too much in stocks. I do think 50 to 75%, at least based on Bengen's analysis, and everything I've read since then, is probably the sweet spot. I personally would tend towards the higher allocation of 75% stocks, but of course, what you do, totally up to you and your circumstances. That's the first thing. The second thing is, don't assume that just because a target date retirement fund is offered by a great institution, and you all know I'm a fan of Vanguard, it doesn't mean that it makes sense for you, or that using the target date retirement fund would be consistent with the 4% rule. You need to dig into the details, see what the asset allocation is, and how it will change as you enter retirement and move through retirement. Extremely important to understand. I will leave links to all of this in the description below. Of course, if you have any questions, leave a comment. I'll do my best to help you out. And until next time, remember, the best thing money can buy is financial freedom.